Welcome to Capital Connections, where the complex world of finance becomes approachable, practical, and ready for your entrepreneurial journey. I'm your host and capital coach, Lorette Farris, a seasoned financial services thought leader whose journey through investment banking, mergers and acquisitions, business brokerage, and crowdfunding has well positioned me to have these conversations with you. This podcast is your gateway to demystifying the pillars of business growth. Each episode breathes new life into our popular business lifecycle journey blog series, Growth by Acquisition, Getting Investor Ready, and Exit on Your Terms, transforming these insightful articles into engaging audio and video content. Whether you're a startup to development stage venture, micro to small business, solopreneur, professional in the throes of a corporate career, or a technician stepping into the realm of independence, this show is your weekly dose of capital wisdom. Our approach? Simple yet profound. We break down high-level financial concepts into everyday language, making them accessible and actionable for businesses of all sizes. From seed stage startups to flourishing small enterprises, the insights here are tailored to fuel your growth trajectory. But we don't stop there. Capital Connections isn't just about solo insights. We bring in the big guns, thought leaders and financial experts who've been in the trenches offering their pearls of wisdom. Their stories, strategies, and hands-on advice add a rich, multi-dimensional perspective to every topic we cover. So, tune in, turn up the volume, and get ready to connect the dots in your business life cycle journey. Whether it's securing investors, planning an acquisition, or crafting an exit strategy on your terms, Capital Connections is your partner in making it happen. Subscribe now and join our community of forward-thinking entrepreneurs and professionals turning their business dreams into reality. Okay, let's get started with episode 2 in the 15-part Growth by Acquisition series. This is titled Navigating New Horizons, Growth by Acquisition, when startups should consider buying a business as a growth strategy. In the current business climate, significant changes occur as baby boomers retire and many businesses undergo a changing of hands. This rotating market creates a ripe and burgeoning opportunity for startups looking to expand and grow through acquisition. This growth strategy has the potential to be highly advantageous as it offers a fast track to scaling operations, diversifying product offerings, and tapping into established customer bases. When considering whether to acquire a business, startups must carefully evaluate the potential benefits and drawbacks. One of the key advantages is the ability to gain access to a more extensive customer base quickly. By acquiring an existing business, startups can instantly tap into a pool of local, loyal customers already familiar with the acquired company's products or services. This increases revenue potential and provides a valuable foundation for future growth. Another significant benefit of acquiring a business is the opportunity for diversification. Startups often face the challenge of limited resources and the need to focus on a core product or service. However, through acquisition, they can expand their offerings and enter new markets, reducing their reliance on a single product or market segment. This diversification not only helps to spread risk, but also opens up new avenues for revenue and growth. Additionally, acquisition can provide startups with access to valuable assets and resources. Acquiring a business can bring in new talent and expertise and provide access to physical assets, proprietary technologies, or established distribution channels. This can significantly enhance the startup's capabilities and competitive advantage, allowing for faster growth and market penetration. Despite the numerous benefits, it is essential for startups to carefully consider the financial aspects of acquiring a business. The purchase of an established business often requires significant capital. Startups must assess their financial position and evaluate the potential return on investment before committing to such a move. Fortunately, various options are available for accessing the necessary capital, such as securing loans, seeking strategic investors, or even crowdfunding. The current business climate, marked by retiring baby boomers and changing ownership of businesses, presents a unique opportunity for startups to acquire through acquisition. When executed strategically, acquiring a company can provide startups with rapid scaling, diversification, and access to established customer bases. However, it is crucial for startups to carefully evaluate the financial aspects and explore capital options to ensure successful acquisition. So, with careful planning and execution, startups can leverage this burgeoning market to fuel their expansion and establish a strong foothold in that industry. So let's talk about identifying the right time for an acquisition. The strategic timing of an acquisition is crucial to its success. For startups, it is recommended to consider acquisition after achieving stability in your product or service offering and demonstrating a viable business model. This is typically when the startup has gained some significant market penetration and seeks to expand into new markets or diversify its offerings swiftly. To illustrate, let's take the example of a tech startup that has established a solid user base for its innovative app. Acquiring a complementary software company would enable rapid expansion of its product line and user base. This strategic move can help the startup outpace competitors and bridge gaps in expertise or technology. The advantages of acquiring an existing business really is that acquiring an existing business can bring numerous advantages that significantly impact a company's growth and success. First, one gains immediate access to an established customer base by purchasing an existing business. Building a clientele takes time and effort, but an existing business already has overcome these hurdles. This means that the company can start generating revenue from day one rather than going through the challenging process of attracting and retaining customers. Moreover, an existing business often possesses valuable assets such as physical infrastructure, equipment, and inventory, which can be costly and time-consuming to build from scratch. By acquiring an established business, one can save money and resources by already having these assets. Additionally, buying an existing business provides the opportunity to receive invaluable knowledge and expertise from the previous owners. This experience transfer can be instrumental in understanding the market, business operations, and industry-specific nuances, enabling a smoother transition and better decision-making. From a financial perspective, acquiring an existing business can be more advantageous than starting one from scratch. The acquired business may already have a proven track record, making securing financing easier and attracting potential investors. This increased credibility can also lead to lower borrowing costs and more favorable negotiations with suppliers and vendors. And then lastly, by acquiring an existing business, you might eliminate potential competition that could have arisen if choosing to start a new venture. This competitive advantage allows for a more significant market share and a head start against other players in the industry. So there are multiple advantages to acquiring an existing business, and let's just talk about a couple of them. First, establish operations. Acquiring a business means accessing base operational systems, which can fast-track expansion and bypass the growing pains typical to a new venture. Then there's immediate cash flow. Unlike starting from scratch, an acquisition often provides immediate cash flow from existing sales, which can be crucial for a startup's financial stability. Of course, there is the customer base. Access to an existing customer base accelerates growth and provides immediate market feedback for more products or services. Then you have brand recognition. Acquiring a business with a recognized brand can significantly boost a startup's market presence. Talent and experience. An acquisition can bring in a skilled workforce, saving time and resources on hiring and training new employees. So preparing financially for the acquisition, this becomes really important. In the process of acquiring a business, financial readiness plays a vital role. Startups must comprehensively understand their financial situation, encompassing cash flow, projected revenues, and available capital. This level of preparedness ensures the newly acquired venture's sustainability and facilitates securing the necessary funding for the acquisition. So to illustrate, suppose a startup intends to acquire a small e-commerce platform. In this case, it becomes imperative for them to meticulously organize their finances, as potential lenders or investors will closely scrutinize these details during those financing discussions. This entails maintaining up-to-date financial statements, establishing a suitable credit score, and potentially providing collateral if that's required. Then there's accessing capital for the purchase. So securing capital for an acquisition can indeed pose quite a challenge for startups. However, underlying alternatives and avenues can be explored to overcome these hurdles. One possibility includes seeking out venture capitalist firms or more so angel investors specifically interested in supporting and funding startups. These entities often have a vested interest in the success of innovative businesses. They are more likely to provide the necessary funds for an acquisition. Another avenue to consider really is reaching out to financial institutions such as banks or credit unions to explore the possibility of obtaining a loan or establishing a line of credit. This option allows startups to leverage their assets and creditworthiness to secure the required capital. Additionally, startups may opt for strategic partnerships or collaborations with established companies in their industry. This approach can provide financial backing and often open doors to valuable resources, expertise, and networks. And then there is a final. Crowdfunding platforms offer a unique opportunity for startups to raise capital directly from a large pool of individual investors interested in supporting innovative ideas. So by carefully considering and exploring these different avenues, startups can increase their chances of securing the capital needed for a successful acquisition. Now, there are several avenues that startups can explore, and this is just to expound on what we just talked about a little bit, the traditional bank loans, right? Because you're buying an asset. A common source of financing that individuals and businesses often turn to for those financial needs is a loan. Loans can offer the necessary funds to support various endeavors such as starting the new business, purchasing a home, or financing higher education. However, obtaining a loan typically requires substantial documentation and collateral to secure the lender's confidence in repayment. Lenders must assess the borrower's creditworthiness and ability to repay the loan based on their financial history, income, and assets. The process involves providing bank statements, tax returns, employment verification, and sometimes even personal references. Additionally, lenders may require collateral, such as real estate or vehicles or assets of the business, to guarantee the loan, providing them with an alternative source of repayment in case of default. So while the documentation and collateral requirements may seem burdensome, they protect both the lender and the borrower, ensuring the loan is mutually beneficial and secure. But then supporting that is the SBA loans. The U.S. Small Business Administration, while it's a government agency, it aims to support small businesses in various ways, including financial assistance. One of the ways the SBA assists startups is by offering loans with lower down payments and extended repayment terms. This can be incredibly beneficial for entrepreneurs starting their businesses who may not have significant capital or resources. By requiring a lower down payment, the SBA's loans help alleviate some of the financial burdens that startups typically face when securing funding. Additionally, the extended repayment terms allow new businesses more time to generate revenue and establish themselves in the market before facing the pressures of high monthly loan payments. This flexibility can significantly contribute to the long-term success and stability of the startup. With the SBA's loan programs, aspiring entrepreneurs have a better chance of turning their ideas into thriving businesses as they are provided with the financial support and breathing room necessary for growth and development. And in that startup space, we know there are the angel investors. So these investors who have a keen eye for profitable ventures are always on the lookout for opportunities that have the potential to yield significant returns on investment. They will provide the necessary capital for acquisitions when they identify such opportunities. These investors can assess a venture's potential return on investment By analyzing market trends, competitor analyses, and growth projections, once convinced of its profitability, they decide to invest their capital, whether it is a promising startup, a thriving company needing expansion, or a lucrative real estate project. These investors play a crucial role in providing the financial support required to complete the acquisitions. With their capital infusion, these companies can fuel their growth, expand market reach, and maximize profitability. This symbiotic relationship benefits investors who reap substantial returns and the companies who receive the necessary funds to unlock their full potential. One thing we didn't talk about yet is seller financing. In certain business transactions, it is not uncommon for the seller to offer financing options as part of the sale agreement. This can be highly advantageous to the arrangement for both the buyer and the seller, creating a win-win situation. For the buyer, it provides a financing solution that may be more flexible or favorable than seeking a traditional loan from an external source. This can help alleviate some of the financial strain or barriers to entry. Additionally, the seller benefits from this arrangement as they can receive a higher sales price for their business by offering financing. This allows them to spread the receipt of payments over time, which can be particularly helpful if they want to minimize their tax liability or desire a steady income stream. Furthermore, it demonstrates confidence in the viability and profitability of the business, which may increase buyer interest and facilitate a smoother transition. Overall, seller financing can be a mutually beneficial strategy that allows both parties to achieve their goals in a business sale. And then there's more. There are the alternative lenders. In today's digital age, online platforms and fintech companies have revolutionized the lending industry by introducing more flexible options for borrowers. Unlike traditional banks, which often have rigid and cumbersome lending policies, these modern platforms provide a refreshing alternative for individuals and businesses needing capital. With streamlined application processes, faster approval times, and user-friendly interfacing, online lending platforms have made it easier than ever to access funds. Moreover, fintech companies leverage advanced algorithms and data analytics to assess credit risk, enabling them to provide personalized loan terms based on individual creditworthiness. This level of customization allows borrowers to find the best lending options that suit their unique financial situations. So, online lending platforms often offer competitive interest rates and fee structures, ensuring borrowers can choose the most affordable solution. As a result, the growing popularity of these platforms has disrupted the traditional banking sector, empowering borrowers with a wide range of flexible lending choices. For example, a startup looking to acquire a local retail store might use an SBA loan for financing, benefiting from favorable terms and lower interest rates. Alternatively, they might negotiate seller financing where the seller agrees to accept payment over time, usually with interest. So in conclusion, growth by acquisition is an effective strategy for startups seeking rapid and substantial growth. This strategy is especially advantageous in today's market, which is characterized by a high number of retiring baby boomer business owners. These retirements have resulted in many opportunities for startups to acquire established businesses and leverage their existing customer base, brand recognition, and resources. However, timing is crucial for a startup to execute this growth strategy successfully. The startup must be financially prepared to acquire, as this process can be costly. A significant consideration in this regard is access to capital. Startups must ensure they have adequate financial resources to support the purchase of the targeted business and the operation and integration of the acquired assets. So fortunately, there are several financing options which are available, ranging from traditional bank loans to angel investors, and again, the seller financing. By carefully evaluating the timing of acquiring another business, adequately preparing financially, and exploring these various areas for capital infusion, startups can position themselves to unlock new horizons and thrive in the highly competitive business landscape. So, in navigating new horizons, we uncovered when the transformative step of acquiring a business aligns perfectly with a startup's strategic growth journey, leveraging existing markets for exponential success. Next week, join us as we then explore the acquisition advantage, scaling small businesses, where we are going to guide you through the maze of the market and how to pinpoint those golden acquisition opportunities that could skyrocket your business's growth. Thank you for tuning in to this week's Growth by Acquisition, the second article in the series. See you next week. That wraps up another enriching episode of Capital Connections. Thank you for joining us this week to navigate the ever-evolving landscape of business and finance. Your journey toward growth and success is our top priority. Don't forget to follow the Capital Navigators blog for an in-depth read on each topic we cover. It's your go-to resource for insights and strategies that can transform how you approach your business challenges. You can also stay informed and ahead of the curve by following our company page on LinkedIn, connecting with a community of like-minded professionals and entrepreneurs on their path to making a mark in the business world. Remember, when you're ready to elevate your game and move to the next stage, our doors are always open. Join a masterclass for an immersive experience in business strategies, or take a step further by registering for our mastermind group. Here, you'll engage in experiential learning to craft and refine your strategic plan, guided by experts who walk the path. At Capital Connections, we're not just about imparting information, but about creating experiences that transform. So, until next time, keep connecting the dots in your financial journey, and let's continue to grow, innovate, and lead together. Thank you again for tuning in, and see you in the next episode of Capital Connections.